Hello, Ken AG here. Welcome back. I'm going to start this video in the simplest way possible. Silver is up 26% from Monday's low, and that's not normal after a shock. When a market takes a punch, it doesn't get up smiling the next week like nothing happened. Normally it limps, it hesitates, it tries to catch its breath. But silver didn't do that. Silver did something else. It made the market say, without words, something you only understand after you've been hit a few times. Physical metal does not agree with this drop. And today, Wednesday, February 4th, was one of those rare days when the market speaks loudly. Not euphoria, a signal. If you've been here for a while, you already know I'm not the it's going to explode tomorrow guy. And I'm not the it's overrun guy either. I'm the understand what's happening before you react guy. Because people who react on impulse become fuel for everyone else. So stick with me until the end because I'm going to give you 3 simple signals to watch this week. Simple. No magic formula, no secret indicator, Asia premium, gold above 5,000, silver and backwardation the right way to look at it. And if those 3 confirm, the next move could catch a lot of people off guard, including big money. Also drop a comment below. Are you excited about this rebound or are you suspicious? I read everything and reply when I can. Quick disclaimer, educational content, not financial advice. You're an adult, you decide. Now let's get to the numbers. But my way. Numbers with meaning, not numbers for the sake of numbers. Starting in the West with the noisiest thermometer, COMEX. Gold did something that isn't just price, it's collective psychology. It reclaimed the $5,000 level. Today it's around 50.42, up about 3.1%. And here's a detail that sounds small, but it was the entire face of this market right now. A $152 swing in 24 hours. That's not a calm market. That's a market rewriting risk in real time. Think about what a $152 move means. That's 3% of gold's value moving in a single day. For context, the entire stock market moving 3% in a day is considered extreme volatility, and gold just did it. But here's what matters more than the move itself, the direction. Gold didn't just bounce. It didn't give a weak relief rally that stalled. It powered through resistance. It reclaimed 5,000, which is a psychological level that everyone watches, and it held there. That tells you buying is real. Not panic covering, not short-term speculation, real accumulation. Silver followed, but silver didn't follow normally. Silver did what silver does when the market tries to force it down. It's up 26% from Monday's lows and pushed back above $91. Now tell me, after a flash crash, what would be normal? A slow grind higher, hesitation, givebacks. A lot of, I don't know, but silver came back with force. Let me explain why this recovery pattern matters. In technical analysis, the character of a bounce tells you a lot about underlying demand. Weak bounces are characterized by low volume, choppy price action, and quick reversals. They're short covering, they're relief, but they don't last. Strong bounces show high volume, clean price action, and sustained momentum. Those are accumulation. Those are real buyers stepping in. And what we saw this week was a strong bounce. Volume was elevated, price action was clean. There were no major givebacks. That tells you this wasn't just traders covering shorts. This was fundamental buyers, recognizing value and stepping in aggressively. And when you get that kind of buying after a massive flush, it usually signals the correction is over. Platinum 2287, up 3.5%. Palladium 1789, up close to 3%. And even copper, after a pause, down less than 0.5%, held resilient around 603. Translation, this wasn't just a good day, it was a repositioning. The entire metals complex moved together. That's significant because it tells you this isn't isolated to one metal. It's a sector-wide shift. Now come with me to the other side of the world because this is where a lot of people miss the movie. In Shanghai, gold is around 50.63, so gold is basically synchronized globally. That matters because it tells you this isn't just dollar and sentiment. There's real bid. When gold trades at similar prices across regions, it means arbitrage is working. It means capital can flow freely. It means the market is liquid and functional. But look at silver in China, $106.25. I'm going to repeat that slowly because this is the kind of number that separates watched the video from understood the market. West 91, China 106.25. That's not a detail, that's a message. It's like the East is saying, thanks for the paper discount, we'll take the metal. Let me explain why this premium is so important. In theory, arbitrage should close price gaps. If silver is 91 in New York and 106 in Shanghai, someone should buy in New York, ship to Shanghai, sell at 106, pocket the $15 spread. That arbitrage would push New York prices up and Shanghai prices down until the gap closes to just the cost of shipping and insurance, maybe $2 or $3, but that's not happening. The gap stays at $15. Why? Because you can't source physical at 91. The paper price quotes 91. But try to buy a 1,000-ounce bar for immediate delivery and you hit premiums, delays, unavailability. The arbitrage doesn't work because the markets are disconnected. Paper trades at 91, physical trades at 106, and that disconnect is the story. And in India, on the MCX, silver is around 91.03, a healthy 3.5% premium versus Western prices. When you see a persistent premium in physical demand hubs, you have to stop and ask the right question. What is paper trying to prove that physical refuses to accept? Now let's talk about why this rebound is so significant. Early this week we had volatility and a flash crash, and a lot of people read that as it's over, but the market has a cruel pattern. It drops first, it tests the leveraged, it forces weak hands to sell, and only then does it show direction. That's what this week was, a conviction test. And there's a type of person who loves this setup, the experienced buyer. He doesn't buy tops, he buys panic. So what looks like chaos is often an entry disguised. This is a critical psychological concept. Novice traders buy strength and sell weakness. They chase momentum up and panic, sell on the way down. That's the losing strategy. Professional traders do the opposite. They sell strength and buy weakness. They fade the crowd, and they profit from emotional extremes. What happened Monday was an emotional extreme. Panic selling, forced liquidation, fear, and professional buyers recognized it as opportunity. They stepped in while retail was capitulating. And now, a few days later, they're sitting on double-digit gains. That's how wealth transfers in markets, from the emotional to the rational, from the weak hands to the strong hands. Gold above 5,000 is a psychological win, yes. But more than that, it's the market saying the bigger trend is still alive. And to make that even clearer, UBS raised its gold outlook to something like 6,200. I'm not citing that so you believe UBS. I'm citing it because when a big bank changes a number, it's not emotion, it's scenario adjustment, demand, geopolitical risk, flows. Banks like UBS don't make price targets based on feelings. They have models, they have commodity analysts, they have access to flow data that retail doesn't see. When they raise a target from 5,500 to 6,200, it means their models are showing stronger fundamentals than previously expected. Maybe central bank buying accelerated, maybe supply got tighter, maybe demand projections increased. Whatever the inputs, the output is a higher target. And that reflects institutional positioning. Now the star, silver. It recovered more than 12% in a handful of sessions after the correction. But the detail that changes everything is an ugly word with a beautiful meaning, backwardation. And I'll explain it the way I explain it to someone who isn't required to speak finance. Normally, futures trade above spot because there's cost to carry, storage, insurance, financing. If I buy silver today and store it for 3 months, that costs money. So the 3-month futures price should be higher than today's spot price to compensate me for those costs. That's called contango. It's the normal state of commodity markets. But when backwardation happens, it flips. The price of metal right now becomes more expensive than the price for later. Human translation, I want the metal now. I'll pay more for it now. That's a classic signal of physical tightness. Because if physical was abundant, if supply was easy, no one would pay a premium for immediate delivery. They'd be happy to wait 3 months and save money. But when backwardation appears, it means someone needs metal today and can't wait. Maybe it's an industrial user who needs silver for production. Maybe it's a trader who's short and facing delivery pressure. Maybe it's a sovereign buyer accumulating strategic reserves. Whatever the reason, the message is clear. Immediate metal is scarce. And when you combine backwardation with India surging, more than 15,000 rupees per kilo in a move, you realize this isn't just Western speculation. This is global urgency. India is one of the largest silver consumers in the world. They import roughly 200 million ounces per year for jewelry, for investment, for cultural purposes. When Indian buyers surge into the market, when premiums spike, that's real demand. That's physical metal leaving vaults and entering hands that won't sell it back quickly. And here's a point I like because it's rare to see someone nail two things in sequence. David Hunter believes silver can hit 180 in 2026. And the key detail is he also warned about a drop when silver reached 125. Silver hit 122 and the drop came. You don't have to follow anyone, but you should respect it when someone nails risk timing and still holds their target thesis. Let me explain why this matters and why Hunter's call is significant. A lot of analysts make bold predictions. Silver to 150, silver to 200, gold to 10,000. These headlines get attention, they get clicks. But when volatility hits, when price drops 40%, most of these analysts change their tune. They say the bull is dead, they reverse their calls, they find new narratives. That's not conviction, that's reacting to price. That's trading sentiment, not fundamentals. Hunter is different. He called the drop. He explicitly warned when silver was around 125 that a significant correction was coming. He wasn't vague. He wasn't hedging. He said it clearly. And when silver crashed from 122 to 78, his warning was validated. That's rare. Most analysts who make price predictions don't also make timing calls on corrections. They just give an upside target and hope. Hunter gave both. And now, after the drop, after the 40% correction that scared most people out of the market, he's reiterating the 180 target for 2026. That's conviction based on a thesis, not a price chart. His thesis, as I understand it, is that we're heading into a period of extreme monetary instability. Currency debasement on a scale we haven't seen, fiscal dominance, where governments force central banks to keep rates low despite inflation, central banks losing independence, and in that environment, hard assets, particularly silver, with its dual monetary and industrial demand, will massively outperform financial assets. The drop from 122 to 78 didn't change that thesis. It was a correction within a bull market, a flush of leverage, a shakeout of weak hands. But the underlying drivers, the monetary instability, the supply deficit, the industrial demand growth, none of that changed. And now the bull is resuming. That's what Hunter is saying. And based on his track record of calling both the top and the correction, it's worth paying attention to. Now, copper. I know some people ignore copper, but copper is the metal that whispers before the market screams. Some Goldman analysts are cautious, sure, but there's another story developing. Supply risks at Chinese smelters. And that matters because it's not just demand went up, its supply might choke. When supply chokes, when production faces constraints, prices have to rise to ration demand. That's basic economics. And you know what's even more interesting? Chinese manufacturers are already buying the dip after the roughly 12% correction. When an industrial buyer buys weakness, they're not betting. They're securing production. Industrial buyers don't speculate. They have to buy. They need the metal to manufacture products. So when they buy into weakness, it tells you they believe current prices are attractive relative to future needs. And that's a strong signal. And here's a geopolitical detail I want you to keep. The U.S. announced Project Vault, a $12 billion fund to secure strategic mineral reserves. When the two biggest economies on Earth start competing for metal, that creates an invisible floor. It doesn't mean price can't drop. It means drops become inventory opportunities. And that changes the game. Think about what Project Vault represents. The U.S. government recognizing that strategic minerals are national security assets. They can't rely on foreign supply chains. They can't rely on market availability. They need reserves. And they're willing to spend $12 billion to build them. That's not a trivial amount. That's serious capital. And when governments enter markets as buyers, when they're accumulating regardless of price, that creates structural demand that didn't exist before. Another piece that looks peripheral but isn't: mining. Impala Platinum expecting profit up as much as fivefold. That tells you that despite the noise, the extraction machine is printing money, and that attracts capital, because when producers expand margins, the whole chain breathes. Capacity investment, expansion, confidence in the sector. When miners are profitable, they invest in exploration. They develop new projects. They expand capacity. And that creates a positive feedback loop for the entire sector. And here's something a lot of people will ignore, but I won't. ProShares filed to launch 2x leveraged ETFs for gold, silver, copper, platinum, palladium. That's a retail is coming signal, yes, but it's also the financial industry trying to capture flow. And where there's new product, there's expectation of interest. Financial companies don't launch products for fun. They launch them when they see demand, when they see retail interest building, when they want to capture flows. The fact that ProShares is launching leveraged metals ETFs tells you they expect significant retail participation in this cycle. Now, what I promised, 3 simple signals for this week. Signal number 1, Asia premium. I want to see whether the silver premium in Asia stays firm. Because when the premium drops, it's okay, normalized. When it holds, it's physical as pulling. And when it rises, that's when it starts getting dangerous for shorts. Why does this matter? Because Asia is where physical demand concentrates. China and India together consume over half of global silver. When premiums in those regions stay elevated, it confirms that physical tightness is real. It's not just a Western paper game. It's global supply shortage. And shorts who think they can keep suppressing paper price face a problem. Physical buyers keep pulling metal out of the system. Eventually, the shorts run out of metal to deliver. And when that happens, prices explode. Signal number 2, gold above 5,000. This is psychological and technical. Gold above 5,000 becomes a mental anchor. From there, the conversation shifts from does it come back to how high can it go? And when gold holds a psychological level after a shock, it's usually not weakness. It's absorption. Absorption is a technical term. It means sellers are being absorbed by buyers. Supply is being absorbed by demand. And when that happens at a key level, it usually signals that level becomes support for the next leg higher. Signal number 3, backwardation in silver. Not just any backwardation, the sequence and persistence of it. If silver keeps signaling that now is worth more than later, the market is saying immediate metal is scarce. And paper hates that message. Because paper markets depend on the assumption that delivery can always happen, that if you demand physical, it can be sourced. But backwardation signals that assumption is breaking. Physical is tight. And if tightness persists, if it accelerates, paper prices have to rise to reflect physical reality. So let me close the most honest way possible. This week wasn't just a rebound. It was the market testing your psychology. The flash crash was the sieve. It separates people who are here for a thesis from people who are here for adrenaline. And today's reversal, silver up 26% off the low, gold back above 5,000, was the market saying you thought it was the end, but it was the beginning of repositioning. Let me be specific about what that means for you practically. If you sold during the panic, if you capitulated at the lows, understand what happened. You transferred wealth to someone who understood the difference between price and value. That's not a judgment. That's market mechanics. Markets exist to transfer money from weak hands to strong hands, from emotional participants to rational participants. The crash was designed to scare you. And if it worked, if you sold, you became the liquidity. But if you held, if you bought the dip, if you recognized the opportunity, you're now sitting on significant gains in just a few days. That's the reward for understanding structure over emotion, for recognizing that a 40% flush in a bull market is normal, for having the conviction to act when others panic. Going forward, here's what you should focus on. First, monitor the three signals I mentioned. Asia premium, gold above 5,000, backwardation. These aren't magic. They're thermometers. They measure stress in the physical market. And when physical stress increases, when those signals strengthen, it validates the thesis that we're in a structural bull market for metals, not a speculative bubble. Second, understand your position. Are you in for the long-term thesis, or are you trading? If you're trading, you need tight risk management. You need stops. You need to be nimble, because volatility will continue. We could see another 20% correction tomorrow. That's the nature of bull markets. But if you're in for the thesis, if you believe in currency, debasement, supply deficits, industrial demand growth, then corrections are noise. There are opportunities to add, not reasons to exit. Third, avoid leverage on core positions. I can't stress this enough. Leverage is what destroyed people during the crash. They were right about direction. They were right about the fundamentals, but they couldn't handle the volatility. They got margin called at the worst possible price. If you own physical or unleveraged positions, you control the timing. Nobody can force you out. That's the power of patience and proper positioning. Will this turn into a move that catches a lot of people off guard? It depends on one thing, whether physical keeps contradicting paper. And that's why I want your eyes on these three signals this week. Not to guess price, to avoid getting blindsided. Because the next leg of this move, if it happens, will be fast. It will leave people behind. And by the time it's obvious to everyone, the big gains will already be captured. If you like this kind of analysis, no theater, no promises, no fantasy, hit like and subscribe. More than 83% of viewers aren't subscribed. And I get it. Nobody wants to commit. But subscribing here is a message to the algorithm that you want content that respects your intelligence, content that focuses on mechanics, not hype, content that helps you understand markets so you can make better decisions. Drop your opinion below. Are you watching this thinking it's the start of the next leg, or are you skeptical? Are you positioned, or are you waiting? I read everything and reply whenever I can. Because this channel isn't just me talking at you. It's a conversation. It's a community of people trying to understand markets in a world where most content is designed to manipulate emotions rather than inform minds. Thanks for being here. Thanks for thinking critically. And I'll see you in the next one.